Have you ever wondered why, no matter what laws or legislation are put into place, our economy never improves? Have you wondered why it seems that political figures who oppose the system are targeted? To understand that, we need to talk about central banks, the wizards behind the curtain of our economy, quietly controlling everything from your mortgage rate to the price of your morning coffee. The mysteries behind how the central bank works isn't by accident. They don't want the average person to understand how they work, or even who is at the controls. This video is going to look at that and a lot more. While most of us go about our daily lives, these institutions are making decisions that ripple through every corner of society. Their influence is so vast it's almost invisible, yet it touches every transaction, every loan, and every paycheck. This video will look at the power the central bank has over the economies around the world and the fate of the leaders who oppose it. Leaders who go against the central bank often meet a similar fate. JFK, Gaddafi, and Hitler were famously opposed to the system. We will also see what leaders besides them are opposed to the central banks. It's more than just coincidence that if you oppose the system, you are labeled a threat to the free world. We'll also look at the BRICS organization as well as cryptocurrency. It's a lot to unpack, so please stick around. I think you might find it interesting to learn how all this ties together. And obviously a video exploring the control of the central bank system wouldn't be complete without a little bit about the Bank of Rothschild. If you want to learn more about subjects like this and history in general, please take a second to subscribe to my YouTube channel. I cover a lot of subjects, so I think anyone can find a video they enjoy on my channel. Thank you for supporting my work. So, whether you're buying lettuce at the grocery store or filling up your gas tank, the cost you pay is shaped by choices made in boardrooms you'll never see. Central banks are the government's bankers, tasked with keeping the economy stable, a job that's as tricky as herding cats, and just as unpredictable. They're expected to step in when things get shaky, acting as a safety net for the entire financial system. Their main tools? Interest rates, which they can raise or lower to influence how much money flows through the economy. And then there's quantitative easing, which is really just a technical way of saying they can create new money out of thin air, flooding the system with cash when things get tough. When the economy slows, central banks lower rates to encourage people and businesses to borrow, invest, and spend. Suddenly, loans are cheaper, credit cards are friendlier, and shopping sprees seem a little less reckless. But when prices start rising too fast, when inflation spikes, they slam on the brakes, raising rates to make borrowing more expensive and cool things off. It's a delicate balance, and getting it wrong can mean economic pain for millions. It's a high-wire act, performed above the heads of billions, and we're all watching, sometimes nervously, sometimes obliviously, as they try to keep the economy from tipping over. Central banks are supposed to provide stability. They're supposed to keep things calm, prevent crises, and step in when panic threatens to take over. But they also fund wars, so it's easy to see why some don't like them. But their immense behind-closed-doors power makes many uneasy. Decisions are made in secret meetings, with little public input, and the consequences can be felt for years. So, who are these people really? What drives their decisions? And what happens when their fixes create even bigger problems than the ones they set out to solve? Let's dive in and pull back the curtain on the financial world's most overlooked overlords. The story of central banking begins, perhaps unsurprisingly, with war and the insatiable appetite of governments for money. In the 17th century, European monarchs and states found themselves constantly short of funds, especially when it came to financing their endless wars and ambitious projects. With treasuries running dry, they turned to wealthy private bankers, men who could provide the vast sums needed, but always at a price. These early deals were less about public service and more about mutual benefit. Governments got their cash, and bankers received lucrative privileges, influence, and sometimes even the right to issue money themselves. The Swedish Riksbank, founded in 1668, holds the title of the world's first central bank, but it was the Bank of England, established in 1694, that truly set the standard. The Bank of England's model was simple but powerful: lend to the government in exchange for special status, and gain the authority to issue banknotes that would circulate as money. This arrangement not only stabilized government finances, but also gave the bank immense power over the economy. The idea quickly caught on, as other nations saw the benefits of having a central institution to manage state debt and issue currency. The model spread across Europe and beyond. Napoleon, recognizing the strategic importance of controlling money, established the Banque de France in 1800 to fund his military campaigns and centralize financial power. Meanwhile, in the United States, the idea of a central bank was hotly debated. The U.S. experimented with two early central banks, but fierce opposition from those wary of concentrated power led to their demise. Throughout the 1800s, America swung between attempts at centralization and periods of decentralized, chaotic banking. This era, known as free banking, was marked by a bewildering array of private banknotes. Each bank issued its own currency, leading to confusion, rampant speculation, and frequent financial panics. Bank failures were common, and the public's trust in money itself was often shaken. The lack of a central authority meant that crises could spiral out of control, leaving ordinary people to bear the brunt of economic instability. The tipping point came with the Panic of 1907, a financial crisis so severe that it nearly brought down the entire U.S. economy. In response, powerful bankers and politicians held secret meetings, most famously at Jekyll Island, to design a new system. Their solution was the Federal Reserve, created in 1913, which promised to stabilize the economy and prevent future panics. Yet just over a decade later, the Great Depression struck, revealing the limits and unintended consequences of central banking. After the devastation of World War II, the central bank model became nearly universal. International agreements and outside pressures, especially from powerful nations and institutions, encouraged or even forced countries to establish their own central banks. These institutions were tasked with managing national currencies, controlling inflation, and supporting government policies, often with significant influence from foreign advisors. It's important to remember that central banks were not originally created to serve the public good. Their primary purpose was to help governments finance wars, manage debt, and maintain the power of political and financial elites. The idea of central banks as guardians of the average citizen's well-being is a much more recent development, and one that is sometimes more about appearances than reality. Today, central banks present themselves as protectors of economic stability and the public interest. But their origins, and much of their ongoing influence, remain deeply tied to the needs of governments and powerful interests. Their promise to solve problems raises important questions about whose interests they truly serve. If central banks are so controversial, why haven't more countries ditched them? Because once you have one, it's almost impossible to go back. The U.S. tried. Andrew Jackson killed its central bank in 1832, but chaos followed, and the Fed was born decades later. Most cases of central banks disappearing are due to countries themselves vanishing, like South Vietnam or East Germany. The global financial system is built around central banks. Without one, a country is seen as risky and isolated. International trade and investment depend on this network. So, while politicians may rant about abolishing central banks, almost none actually do it. It's a one-way street, and we're all on it. So who's living without a central bank? Mostly tiny nations, Andorra, Monaco, Nauru, Tuvalu, Palau, the Marshall Islands, who simply use someone else's currency. This is called dollarization or euroization. They adopt a major foreign currency for stability, but lose all control over monetary policy. Panama, for example, uses the US dollar, gaining stability but surrendering economic autonomy. Monaco and Liechtenstein piggyback on the euro and Swiss franc, respectively. These aren't bold experiments. They're pragmatic moves by microstates. But what about bigger countries? For a brief period after the Russian Revolution in 1917, Russia actually abolished its central bank, the State Bank of the Russian Empire. The Bolsheviks saw central banking as a symbol of capitalism and tried to replace it with direct state control over money and credit. The result? Economic chaos, hyperinflation, and a breakdown in trade, forcing the Soviets to re-establish a central bank just a few years later. Outsourcing monetary policy means you're still in the global system, just not in charge. In today's world, you can't escape central banks. You can only choose who runs yours. Let's talk about the City of London, a 1 square mile powerhouse that's often overlooked by those outside the world of finance. Nestled within the heart of the UK's capital, this tiny district is home to some of the most influential financial institutions on the planet. Its history stretches back centuries, and its traditions are as old as the British monarchy itself. The city operates almost like a city-state, with its own unique set of rules, its own police force, and the iconic Bank of England at its very core. Here, centuries-old rituals blend seamlessly with cutting-edge financial technology. The relationship between the city and the Bank of England is inseparable. They function in tandem, shaping not just the UK's economy, but influencing global markets as well. The bank sets interest rates, manages inflation, and provides stability in times of crisis. Its decisions can affect everything from mortgage rates in Manchester to stock prices in Mumbai. This is what anchors London's reputation as a global financial capital, drawing in international banks, investors, and corporations from every continent. With so much power concentrated in such a small area, it's no wonder that conspiracy theories thrive. Some people imagine the city, Wall Street, and other financial hubs as shadowy forces pulling the strings of the world economy. The Bank for International Settlements in Basel, Switzerland, is often mentioned in the same breath, seen as a kind of central bank of central banks, coordinating global monetary policy behind closed doors. To some, these institutions are the command centers of a vast interconnected financial empire. While that might sound like the plot of a thriller, the reality is more nuanced. The influence of these organizations is undeniable. Decisions made in their boardrooms can send shockwaves through economies, affecting jobs, savings, and investments worldwide. When the Bank of England or the Federal Reserve makes a move, markets from Tokyo to Toronto react. The 2008 financial crisis is a perfect example. That crisis, rooted in the financial centers of London and New York, exposed just how interconnected and vulnerable the global system really is. In the aftermath, central banks stepped in to bail out the system, not just to protect themselves, but to prevent a total collapse that would have affected millions of ordinary people. Some say it's a secret cabal plotting world domination. It is an exclusive club, one that looks after its own interests, sometimes at the expense of transparency and accountability. The decisions made in these boardrooms are rarely open to public scrutiny, and the people in charge often move in the same elite circles. Yet, whether we like it or not, the reach of this financial network is truly global, shaping the world we all live in every single day. Wars aren't just about land or politics. Control of money is often at the heart. The American Revolution was partly about resisting British monetary control. In modern times, Libya's Gaddafi planned a gold-backed African currency, threatening Western dominance, until intervention ended that dream, and a new, Western-backed central bank appeared. And if you aren't familiar with his eventual fate, you should look into it. It's not pretty. Iraq tried selling oil for euros, not dollars. Iran has tried to bypass the dollar system too. Both face severe consequences. The message: you can have any political system you want as long as you plug into the approved central banking network. Challenge the system and you risk more than just financial trouble. Western militaries, such as the UN or NATO, will come knocking and convince you to join the central bank system. To put it mildly, monetary independence can be dangerous. After Libya's central bank policies shifted, Muammar Gaddafi's grip on power began to unravel. Internationally, his push for a gold-backed African currency and efforts to sidestep the Western-dominated financial system drew fierce opposition. Western governments, alarmed by the threat to the status quo, quickly rallied against him. NATO launched a bombing campaign under the banner of humanitarian intervention. But the timing was no coincidence. Libya's financial ambitions had made Gaddafi a target. As the conflict intensified, rebel forces gained ground, backed by international support and a newly established, Western-aligned central bank. Gaddafi's regime collapsed with shocking speed. In October 2011, after months on the run, he was captured and killed by rebel fighters. The international response was swift. Some hailed it as the end of a dictatorship. Others quietly celebrated the preservation of the global financial order. In the end, Gaddafi's fate was sealed, not just by his politics, but by his challenge to the central banking system. His story is a stark warning. Defying the financial status quo can have deadly consequences. If central banks make you uneasy, what else is there? 3 main alternatives: the gold standard, cryptocurrencies, and free banking. The gold standard ties money to a physical asset, limiting government power to print money and promising stability, but it's inflexible in crises. Cryptocurrencies like Bitcoin are decentralized, algorithm-driven, and outside government control, but wildly volatile. Free banking means private banks issue their own currencies, competing for trust. Potentially innovative, but historically chaotic. Each model promises discipline or freedom, but comes with big risks. There's no perfect system, just different trade-offs. The question is, which problems can you live with? Imagine a gold standard. Your savings hold value, but in a recession, the government can't help. Think decade-long depressions. With Bitcoin, you control your money and send it anywhere, but the value swings wildly. Good luck getting a stable mortgage. Free banking? You juggle multiple currencies, constantly checking exchange rates, and a big bank failure could wipe out your savings. Each alternative solves one problem but creates others. Gold brings rigidity, crypto brings volatility, free banking brings instability. There's no free lunch, just a menu of tough choices. The current system gives us inflation and moral hazard, but also flexibility. The alternatives offer different bargains, but none are perfect. It's about picking your poison. Monetary policy isn't just for economists. It shapes your paycheck, your home, your future. Central banks' decisions affect your daily life more than most laws. The system is under strain. Low rates, money printing, and debt have created bubbles and widened inequality. The next crisis could be worse, and understanding these forces matters. These aren't just academic debates. They're about power, freedom, and the future. Don't tune out. Ask questions. Who benefits? What are the consequences? Because it's your money, your economy, and your future. Time to pay attention. What central bank did Hitler eliminate? Adolf Hitler eliminated the Reichsbank, Germany's central bank, in 1939. The industrialization of Germany was mainly financed by the Rothschild central bank. It was only after he decided to get out from under their thumb that he started to face pushback. He replaced it with the German state bank, Deutsche Reichsbank, placing it under direct Nazi control. With this move, monetary policy became the new tool for financing the Nazi war machine. The bank lost all independence, and unchecked money printing fueled military expansion. It was at this point that the central bank started funding military expansion in Western countries in Europe and the US. So basically, the Rothschild banking systems were funding both sides of the conflict at one point. The consequences of Germany's financial independence were severe. Inflation surged, and Germany's entire financial system became distorted. When central banks lose their independence, history shows the results can be catastrophic, not just for economies, but for societies as a whole. In the United States, President John F. Kennedy also questioned central bank power. In 1963, he signed Executive Order 11110, aiming to give the U.S. Treasury authority to issue silver-backed currency, reducing reliance on the Federal Reserve. Kennedy's plan was a move toward reforming or even bypassing the central bank, sparking debate about monetary control and government power. Although his assassination soon after left the order's impact limited, it remains a powerful example of how central bank independence and its alternatives can shape a nation's destiny. Few names spark as much intrigue or controversy in the world of finance as the Rothschilds. Over the centuries, this banking family has become the subject of countless rumors, conspiracy theories, and whispered legends about their supposed control over the world's central banks. But how much of this is myth, and how much is actual history? Let's start with the facts. The Rothschild family began their banking empire in the late 1700s in Frankfurt, Germany. By the 19th century, they had established branches in major European cities: London, Paris, Vienna, Naples, and Frankfurt, creating the first truly international banking network. Their influence was undeniable. They financed governments, funded infrastructure, and helped shape early international finance. But what about central banks? It's true the Rothschilds had relationships with several central banks, particularly in England, Germany, and France. They often acted as government bankers, managing national debts or negotiating loans. Is the idea that they owned or secretly controlled central banks real? Central banks like the Bank of England and the Banque de France were public institutions with government oversight, not private Rothschild enterprises. So where do the myths come from? The Rothschilds' immense wealth, international reach, made them targets for suspicion and conspiracy theories, especially during times of social upheaval. Over time, these tales grew into elaborate legends about shadowy control over global finance. Did the Rothschilds' direct influence over central banks fade as the 20th century progressed? Modern central banks are governed by public policy, not private families. While the Rothschilds remain influential in finance, their power today is a far cry from the all-controlling dynasty IR was. But their financial power does give them political power. That's clear. So next time you hear a story about the Rothschilds pulling the strings behind the world's central banks, remember history is often stranger and far more nuanced than fiction. When people talk about central banks, the question of ownership often sparks confusion and sometimes wild speculation. So let's clear things up. Do central banks have shareholders, and who are they? Most central banks do have shareholders, but who those shareholders are depends on the country. For example, in the United States, the Federal Reserve is made up of regional reserve banks. These regional banks are owned by private member banks in their districts, which hold stock in the reserve banks. But here's the catch. This stock isn't like regular corporate shares. It can't be sold or traded on the open market, and it comes with very limited rights. Member banks get a fixed dividend, but they don't have the power to direct policy or claim profits. In other countries, the picture is different. The Bank of England, for instance, is entirely owned by the UK government. The European Central Bank, its shareholders are the national central banks of countries that use the euro. In Japan, the central bank is technically a joint stock company. But the vast majority of shares are held by the government. So what's the bottom line? Central banks may have shareholders, but these are typically either private banks with tightly restricted rights or government entities. You won't find central banks listed on the stock exchange, and you certainly can't buy a piece of one on your favorite trading app. In short, central banks are not private playthings of wealthy individuals or families. They're public institutions, with structures designed to serve national and economic interests, not private profit. So, does President Putin use the central bank? Let's unpack how Russia's central bank actually works, and how much sway Putin really has. The Central Bank of Russia, or Bank of Russia, has a unique design. By law, it's technically independent from the government. Its main goal? To keep the ruble stable and inflation in check, much like other central banks around the world. The bank's governor is nominated by the president, but must be approved by the upper house of Russia's parliament. On paper, that's a system meant to keep things balanced. But here's where things get interesting. While the bank is independent in theory, Russia's political system is famously centralized, with President Putin at the top. Major economic decisions, especially during crises, often see the central bank working closely with the Kremlin. For example, after Western sanctions hit in 2014 and again in 2022, the central bank took dramatic steps to stabilize the economy. Many analysts argue these moves aligned closely with the Kremlin's goals, suggesting that independence can blur under pressure. Still, Russia's central bank has sometimes defied government wishes, like when it raised interest rates or let weak banks fail, even if it caused political headaches. Critics say real independence is limited, while others argue the bank's tough stance has actually helped shield Russia from bigger economic shocks. So does Putin use the central bank? Not in the sense of direct daily control, but his influence is hard to ignore, especially when national priorities are at stake. But what about Putin's growing investment and collaboration with BRICS? Some experts wonder if this could pose a threat, or an opportunity, for the Central Bank of Russia. As Russia pushes for deeper ties with BRICS nations and explores alternatives to the US dollar, the central bank faces new challenges and potential shifts in its role. Some analysts argue that aligning with BRICS could undermine the central bank's independence, as geopolitical goals might override strict monetary policy. Others believe the move could strengthen Russia's financial resilience, giving the central bank more tools to navigate sanctions and global volatility. The geopolitical context is complex. Closer BRICS ties could mean more political pressure on the central bank, but also new opportunities for economic stability. The Bank of Russia remains a key player in the country's power structure, balancing technical expertise with the realities of Kremlin politics. In the end, Russia's central bank walks a tightrope, officially independent but operating in a system where President Putin's preferences are never far from the surface. I thank you for watching for my channel. Please subscribe if you haven't already, and, as always, stay informed.